Namaskara and welcome to BIC Talks, a podcast by Bangalore International Centre, bringing you conversations that move, inform, and encourage discourse.
I think the most important signal that the government is trying to give is they are trying to shift the government money from government spending to government investment. First of all, that's a good thing. I should say the less you spend on running departments, on salaries, on pensions, and other types of annual consumption, and the more you do it on creating infrastructure of different types, the better it is for future growth.
Historically, the country's annual budget exercise has been a major event and spectacle in the annual economic calendar. There was a time when the post-budget analysis by people like Nani Palkiwala used to draw audiences in droves. Of late, with the dropping of the railway budget and the introduction of the GST, the annual budget is increasingly becoming just another important day in the announcements made by the government. This year, there were expectations of a populist budget in view of upcoming state elections, but that did not happen. We have a budget focused on growing capital investments and infrastructure. To discuss this and more in this episode of BIC Talks, we have Pranay Kotasthane, Deputy Director of Takshashila Institution, who teaches public policy, international relations, and public finance at Takshashila's graduate and postgraduate programs. In conversation with Narayan Ramachandran, social entrepreneur, columnist, and emerging market investor. Over to Pranay.
Thank you, Lekha. I'm Pranay, host of today's BIC Talks episode, and welcome Narayan back to BIC Talks to discuss another budget.
Thank you very much, Pranay. It's a pleasure to be here.
So I'm sure all our listeners would have already read many budget headlines and many tweets. So what we decided is to avoid the gory details of sectoral spending and instead try to situate this budget in India's larger growth or degrowth story. So instead of diving in, we will actually zoom out. And that's what we will do in this episode. So Narayan, before we begin, what's the size of the government budget? How do we look at it? What portion of the Indian economy is it? Let's begin there.
Yeah, Pranay, thank you for beginning there because, we've had so much media coverage, papers, television, streaming videos, tweet channels on the budget. And I think if you ask a good section of that group, what do you think the size of the Indian budget is? Most people won't have a clue. Everybody is delved into detail number 400, but nobody quite knows the size of the Indian budget. So just to start there, the size of the Indian budget is about 40 lakh crores. It's actually, to be precise, this year, the expected one for 22-23 is 39.5 lakh crores. If some of you want to convert that into dollars, just divide by 7.5 lakh crores for every 100 billion. So think of it as a $520-ish billion budget or 40 lakh crore kind of budget that India works with. The second element of detail is, okay, if you said, so what are the most important 3 or 4 things on either side of the budget, the income and expenditure side, as you would do in a household? You would know, for instance, that your rent was the largest item of your budget or something like that. And most people, again, have a vague idea, but don't quite sort of situate the budget in that context. So the first thing I will tell you is on the income side, somewhat unfortunately for India, the biggest source of income is debt and interest on savings. So if you want to think of it, it's a way to finance the income each year on the income side. That's the way you get it through that financing mechanism into the budget. In terms of real sort of income, what you would consider wage income or dividend income, the source for the budget, as you would expect, is taxes. And a little bit that comes from dividends and profits from PSU companies and or the RBI nowadays. The RBI is also beginning to give a dividend into the central government. So just order of magnitude, that 40 lakh crores breaks up as 15 lakh crores, which is the single largest item coming from, if you want to think about it as non-tax revenues or sourced revenues, and the remaining 25 lakh crores coming from taxes, dividends, and very, very small portion from profits. The taxes themselves are three quick parts. One part is income tax, one part is corporate tax. These are together, we call them direct taxes. And then the third part, which is obviously becoming bigger and bigger as time goes on, is GST. So for the first time, I think last year, and then certainly beginning from this year as well, the GST component will individually overtake the income tax and the corporate tax components, though each of them order of magnitude is about 8 lakh crores. So if you want to think about this very simply, 40 lakhs crores of income, 15 of which is financed, 25 of which comes from taxes, roughly speaking, a third from corporate taxes, income tax, personal income taxes, and GST. I haven't gotten into the state transfers just yet, but that's the growth side. On the expenditure side, again, as you would expect, because you're doing so much financing and you have done so much financing in the past, the biggest single item is paying of interest. So 10 of the 40 is actually payment of interest. But a comparable item is sort of central schemes that are passed on to the state, but the money goes from central schemes to the state. So that's another 10 lakh crores. So on the expenditure side, you get the central government paying the interest, central government paying states, and then there are some central schemes like defense, etc. Now, the paradoxical thing is, we talk about all these programs. Relatively speaking, they are small compared to the huge size of the 10 lakh crores that we are spending on interest. So part of the worry comes from the fact that India runs what is called a revenue deficit, which is that each year, if you take realized earnings, if you will, realized revenue minus expenditure, we are still in negative and we have to finance that. And in particular, that last year, the adjusted revenue deficit is going to be something like 3.8%, which is very high. And in my view, a self-respecting economy at a moment in time, last year is not a good example only because of the pandemic, but at a moment in time should try to force that to be as close to zero as possible. That said, India has only done it once or twice in its history, and that happened in the high growth years of 2003 to 7. I think it happened in 2007-8.
Yeah, no, that was very useful. It helps realize the size and the fact that actually a portion of that borrowing is going into running of the daily affairs of the government is something that people should know, and we should always consider that whenever we think of a new government scheme starting, right? This is an important consideration. And also going even one step higher, like you said, that 40 lakh crores is roughly 15% of India's economy. And if we have to go even one step higher, as a thumb rule, 1/4 of India's economy is through government expenditure, which is this 15% plus 10% combined by all state governments and local governments. So that's what we are talking about. We are talking about the 15% of India's economy, and how that would be spent was announced in the budget speech and the budget documents on Feb 1. So let's go ahead, Narayan. And speaking about the budget speech and the budget documents itself, there were, first of all, no new direct taxes. There were no big centrally sponsored schemes announced, just a bit of tinkering here and there. The budget speech did have the usual oddity. This time it was a custom duty hikes on umbrellas, which was mentioned. There was also some talk of increase in capital expenditure. But beyond that, there was nothing that rocks the boat, and that is not necessarily a bad thing. So what is the government trying to signal in this budget, according to you?
Yeah, so I think, again, Pranay, good question, because we should really situate budgets in sort of the long arc of a type of government or regime. And in the last 7 or 8 years through NDA 2 and NDA 3 now, I think the most important signal that the government is trying to give is they are trying to shift the government money from government spending to government investment. And the hope is that the government investment, first of all, that's a good thing. I should say, the less you spend on running departments, on salaries, on pensions, and other type of annual consumption, and the more you do it on creating infrastructure of different types, the better it is for future growth. And so I do think in the same way that the Vajpayee government signaled this, 20 years ago, NDA 2 and 3 are also attempting to signal. And I would say this budget is consistent with that signal that we want to shift from government spending to government investment. Now, in one way, the signals have not changed. It doesn't matter which party is in power. And that is, you take this 40 lakh crores and you simply juggle the headlines under which each of those 40 lakh crores is organized. So we've had everything from Garibi Hatao, 40 years ago, to Gati Shakti today. But if you look under it, some 90% of it will be just common and reallocated under a new phrase. So that part of the signaling has not changed in India. It is simply sort of reformatted former expenditure rather than anything else. But the basic signal is investment versus spending. The one other signal I would add in this particular budget, I don't know yet whether it's a formal signal, is that the oddities have come down dramatically. And also the tinkering that is done, which is totally useless relative to this tax rate and that customs and that excise, all of those have come down quite a lot. So I think very wisely the finance ministry has refrained from tweaking things when the purpose of that tweaking is very clearly pointless. But it's been a long Indian tradition to continually tweak it. It's sort of a political signal that, hey, listen, you came to us and we heard you. And I suspect the umbrella thing is also exactly that, by the way. But luckily they haven't done it in instance after instance with very, very, very small tweaks. So I would say that's the principal signal in the budget.
Like you mentioned, I think over the last 4-5 years, because of this rationalization of the centrally sponsored schemes, I think there is less tendency to add new schemes of 100 crores here and 100 crores there. So I guess that has also helped in making the budget speech shorter and focusing on the economic aspects rather than starting another new scheme under another new name.
You're right. That is, they have resisted that tendency, and that's a good thing. And therefore, they're not sort of chomping at the bit to add a new scheme here and there. That said, the tension between state and center on allocations and who has the discretion and all of that has not gone away. But that's a political economy problem where the mechanism of sorting that out, which used to be long ago, the Interstate Council and then the NDC and so on, have not really worked very well. I've actually not even met, leave alone worked. And the role of the erstwhile Planning Commission in trying to bridge some of these gaps is also gone. So we have still tension between state and center on what goes back and forth, how much discretion one has on central schemes, etc.
Right, absolutely. So now let's go on to one more question regarding the income side. You painted a bit of a scary picture about out of the 40 lakh crores, 15 lakh is coming through financing of one way or the other. And any of these deficits will have to be paid in the future. So they'll be paid in the form of higher taxes. If not us, the future generations will pay. So should we be bracing for more tax hikes in the future, given that over the next 4-5 years, at least the government expects deficits to be high because of what the pandemic has done? So should we be bracing for more tax hikes, and is this rising debt to GDP a cause of concern that you observe for the markets, etc.?
Logically, what you say makes sense, Pranay, which is if you have to square the circle in the future, you have to get it from one of these 3 or 4 sources, right? Which is either direct tax, corporate tax, or indirect tax. and or, don't forget, and we'll come back to this, disinvestments. The disinvestment goal, by the way, we haven't spoken about it, is very modest. So I think they have finally marked that to reality of 65,000 crores rather than putting out some number like 2 or 3 lakh crores and then marking it down all over again. But there is a problem here. In fact, I think part of the reason why GST got the momentum it did is that the government has sort of thrown up its hands on its inability to increase direct tax as a way of financing India's budget. Basically, total taxes in India remain in a corridor between gross tax receipts remain in a corridor between 10 and 11% of GDP and have stayed there forever. So I think the advantage of the GST is as the Indian economy grows, the GST automatically grows with it. I don't think, even though logically you would say the rates should increase, I don't think the rate of tax will increase. They will just hope to bring more and more economic activity through the GST into the tax net. And I think you will see that GST as a component financing of the income side of the budget will just go up dramatically over the years. The reason why GST rates itself cannot increase is that the GST rate is outrageously high in India. When it is outrageous. I mean, I've spoken to Vijay Kelkar a few times on this, and I think the early numbers were all in the 10, 11, 12% range. And we've sort of de facto ended up at the 18% range, although there are some below and some above. But I do think that there is really no moral way to suggest that your GST rate at the national level can be higher than 18%. So we're sort of stuck with these kind of broad ranges in income tax and corporation tax and GST for now. I think the next 5 years, you may get tinkering here and there, a surcharge here and there, but I don't think you'll get anything materially different in the tax brackets of these three things.
As you were mentioning, increasing direct taxes has been sort of something that government has given up. And by increasing direct taxes, we don't mean increase the rates, but bringing more people, broadening the base, and in fact, lowering the rates as long as you can get more people into this bracket. And of course, agriculture remains untaxed, and I don't think that is going to change over the next few years. But you were mentioning something about divestment. Do you see something that might happen there over the next few years or no?
Well, actually, for the first time, we have seen some divestment in a long time. So Air India has successfully moved on, and not necessarily divestment, but disinvestment. LIC is well on its way. Most likely either late in this quarter or first thing in the next quarter, LIC will be listed. That, of course, is not divestment in the strictest sense of the term, but it is demonopolization by government, if you want to call it that. But still, I think it's a positive signal. But I fear a little bit that we will only end up doing what the market will accept. And if we spoke about divestment or disinvestment proceeds. But on the flip side, there is a chunk, I can actually read you that number, something like 3.5 lakh crores a year. So just to put it in context, that is roughly the size of the Indian budget Indian defense outlay. Roughly 3.5 lakh crore a year is support to PSUs. So you can think about it, you got defense here, you could double defense if you don't have support to PSUs. But you actually have an equal amount of PSU expenditure. So, I think there's a whole host of PSUs that the government has no business of being in. And there has to be some rationalization in terms of shutting it down and versus just continuing to support. I mean, Air India, as we famously know, was losing 60 crores a day or something to that effect. So something like that, I would say we need to be much more aggressive than we are, so that the structure of the budget improves over time. But good news on the fact that we've at least started.
So let's now shift gears and move into the expenditure side, right? What is the government doing with all this money that it has raised? And I think the central question is, about managing this effect or economic effect of the pandemic. And we've been hearing about this K-shaped recovery, where some businesses have recovered faster, whereas some smaller businesses have been adversely affected, and in fact they are going even worse off than where they were just a year ago. So given that, I think some economists have talked about tackling this as a supply side problem, right? That you put more money into capital spending, infrastructure, and finally it will go into the hands of everyone and economy will get a boost. Whereas some others talk about a demand side stimulus, where actually you need to give more money to people who are adversely affected, either through direct cash transfers or PDS, etc. So how do you see this issue, and has this budget gone on the right track to address this K-shaped recovery?
Yeah, so I fully agree with you, Pranay, that we have had this sort of, you can call it K-shaped, you can call it two-stage, you can call it, everybody was running a marathon, but the people at the back of the pack got set further back, however you define it. So I think that's the reality of how the pandemic has differentially impacted first different classes of society, and then second, certain subsectors more directly than others. I think that is one of the biggest failures of this budget, that it has not been able to combat that at all. In that sense, while populism might be viewed negatively, inclusiveness has been completely dealt with from the supply side rather than from the supply and demand side in this budget. So, even though the opposition is phrasing it in very strict class terms, I would just say that the degree of empathy that is required after such a major shock has not followed through. And I'm certainly not a believer in either populism or dole-outs, but somehow there would have need to be more done on supporting very specific classes and or subsectors of the economy. I think part of the problem is there has not been a rigorous measurement of this at all, right? So everybody sort of journalistically talks about the K-shaped recovery, but the particular construct of what makes up the bottom K and how you would actually begin to address that. See, everybody can think about universal basic income, use the Aadhaar number and distribute, helicopter some money to everybody. But how do you precisely identify which subsegment has had what kind of impact, and does it need, a certain specific kind of impact, or does it a specific kind of support, or is it more monetary support? So I think the work has simply not been done. There are some suggestions, for instance, mortgage sizes that are below a certain threshold could have been benefited in this budget and so on. But I think the hard work of actually identifying all of this has simply not been done. And therefore, in a strange sort of way, 20 years on or 17, 18 years on, we've had a little bit of an India shining budget, which is one supply side, which in any normal context would be fantastic, let me just tell you. But two, I think got a little bit carried away with all drone Shakti and all of this stuff, right? For the farmer who doesn't have water, even though Jal Shakti has received a little bit more money this time, to talk about drones is premature. Of course, it eventually technology is the only way to make some of these circles square. But I would say the marketing aspect of Digital India got the better of the communication, and the reality of this two-speed, two-stage economy has not been fully factored into this budget. And I fear that has not only economic repercussions, which already does, but also that it could result in societal and potentially political economic consequences, because you have this two-stage and then, the so-called inequality. I don't want to define it in Tom Piketty terms, but even if you were running the race and you got set further back, that just the delta in inequality that comes from an external shock like the pandemic has been exacerbated by this, I think, a little bit.
So, given the fact that, as you said, not enough work has been done to even assess the size of this impact, what were the realistic options you think in the hands of the government? Like, would this translate into, let's say, government could have done more Jan Dhan Yojana transfers, or would it be specific, targeted addressing of the MSMEs or small sectors? How would you think an alternative could have looked like?
Yeah, I think the time for cash in the bank is over. We should have done that, in my view, early and stopped it. We neither did it nor stopped it. So by definition, we didn't need to stop it because we didn't do it. But we did give some liquidity support, if you remember the moratoriums and so on for MSME and so on. So I think those were good. The second moratorium extension was probably not necessary, but without getting into the details of any of that, I think we dealt with the first and to some extent the second wave of the pandemic in a certain sort of way, and we are here now. And I do think right now the need of the hour, and I would in fact recommend that we actually have a commission to rigorously identify these effects and specific solutions to get on the other side of this. So we will need medium-term positive MSME. It's not just credit. I mean, credit is certainly one aspect of it. But I do think, for instance, unlike, say, in the US, the restauranting and retailing industry in India is still, just plastered. It's just absolutely knocked out of the system. And, depending on how their balance sheets were, half of them have gone out of business. And the remaining are struggling, particularly in a context in which we are open one day and not open the next. So I do think we will need much more specific, targeted, but this time I would say growth-oriented solutions rather than liquidity or immediate support-oriented solutions, because we need to look ahead to the next 2-3 years rather than will we survive this moment, which is what clearly was the issue during the pandemic.
So now let's go on to the other part about manufacturing, right? And this has long been like a lacune. We've been trying to fix the problem of manufacturing from a long time. But this time the government over the last 3-4 years has this new idea, but it's an old idea in a new name actually, but it's called production linked incentives, right? And a lot of it is being talked about. Now it is spread to 14 sectors around. So what prospects do you see? Are we likely to see some positive trends in manufacturing because of this production linked incentive, which essentially is a cashback? Whatever sales you do, you get some money back. It's an incentive for you to produce more in India, right? So will that work?
Yeah. So first on the basic idea, I like the basic idea. It's, as you say, it's a very old idea. In the old days, it used to be called a piece rate discount, right? So literally, you make an extra piece and you get a discount. But I do like the idea that particularly as the world diversifies from China in this supply chain, there is an opportunity for India to occupy some aspects of it. And I think the PLI is one method of thinking about how people might come over here and set up shop. But I think expanding the PLI to so many sectors is absolute nonsense. It makes no sense at all to expand it to things like textiles, where we have 4 other different kinds of subsidies already going on. And instead, we should focus explicitly on some of the newer age industries, which we are doing, like computer and laptop and mobile phone manufacturing and so on, which is happening. So I would have preferred that this be kept as a very targeted, specific program that measured itself by the total size of it rather than expanding by sectors. I think what happened was that some of the initial success of the PLI in manufacturing of electronic goods, every other ministry decided this is the mechanism to push their ministry, and then piled on. So I think it's a mistake now that we are doing it for the whole economy. And if you do it for wider and wider segments of the economy, then why is it correct that only under the PLI you get a discount? If you're a regular businessman, you don't. So then it sets up all kinds of other things that now there will be some backlash. There will be backlash because PLI is fast-tracked. And, if Samsung says, I'm going to come here and I'm going to do it with this partner in India, then there will be pushback on, why did you do it with this partner? Why is it not L1? Why isn't it that? In a democracy, you get all these kind of questions. But overall, I do think that it starts some part of the economy. There is a step two. First of all, I think PLI shouldn't be forever. I think PLI should also, and Pranay, you and I have spoken about this, virtually every policy we have must come with a death date. So I would put a 10-year death date on PLI, and of which I think 2 are already over, maybe 3. And I would say that for mobile manufacturing and semiconductors and others, for some others, it's relatively new. But once you have that death date in place, essentially get organized for building the supply chain. That's number one important thing. And number two, wherever possible, do technology transfer to indigenize more and more of the supply chain. Rather than simply insist that 30% will come from India or 40% will come from India, actually enable that supply chain depth and supply chain transfer of technology into India. And this requires a lot of work again. And the PLI is an Excel spreadsheet exercise in the Department of Commerce. But the transfer of technology and supply chain depth and diversification is a far, far deeper exercise. And I fear that we will not invest in that part of it, which will then make this an okay idea, but not a fantastic idea, which it has a chance of becoming.
Yeah, and something that you always talk about, the implementation deficit as well, right? Like now, once you are a company who gets a PLI, there is a perverse incentive for you to modify the PLI scheme so that you get this cash back for a longer period of time, and your competitors don't. So that there's a risk of designing it well so that such type of rent seeking doesn't happen. So we'll see when that rubber hits the road, whether those kinds of incentives are stopped and that don't take place. And there's another flip side to it, Narayan. Like you said, the goal of the PLI should be whether we are able to plug into the supply chain or not, right? The global supply chain. And there, I think there is this tendency to see this PLI as a part of Atmanirbharta. And when that Atmanirbharta angle comes in, the government is also talking about higher custom duties, and custom duties are being increased over the last few years. And that leads to this scenario where, the gains from PLI are actually being negated by the higher import costs for our producers. So what don't you think this tinkering of the custom duties is a cause of concern, and why are we doing this?
Yeah, I mean, this is you talked about signaling and starting with a Jaitley budget, which I think was 2017 or so. We started increasing customs duty again. Until then, first starting in 1991 and then subsequently through Chidambaram, through Yashwant Sinha, through many others, we were on a slow downward track on customs duties. But now, I would say starting 2017 or so, we've started an upward track, consistent with the whole world sort of going protectionist. But I think here is where we've missed a beat, because we haven't analyzed that India is one of the biggest beneficiaries of an open economy still. It's true that open economy is not the same open economy in which China made its gains. So the 20-year period starting when China ascended to the WTO. But despite that overall modification, I think India should still have a view that we benefit the most from an open economy, and therefore we should stop from increasing customs duty. And now the word Atmanirbharta has become a bit of a joke, actually. I mean, it's a misnomer. I think maybe I don't know Sanskrit well enough to know whether there is an appropriately. It doesn't mean. I think it's got a two-sided semantic. One side of it is Swadeshi, but the other side of it is a sort of a metaphoric self-reliance, as opposed to it was invented here, right? So I think we should push that second aspect of it, which is to say, hey, listen, we're going to make here. We don't necessarily have pride of authorship, but we're going to make here, and that will allow us to get one, plugged into global supply chains, and two, become much more part of the global open economy, particularly as China cedes some of it to various countries, including us. So I think that nuanced appreciation is yet to take place. It's taking place in the marketplace. So I'm just hoping that the marketplace will sort of force the government to adjust its policies towards that.
Right. Yeah. I talk about Atma Shakti is important, not so much Atmanirbharta. So maybe one more way.
Maybe that's the term. We can say Gati Nirbharta and Atma Shakti. We'll swap the.
Yeah. So we can come up with nice new terms for these. But now the central problem again, Narayan, is that this reforms 1.0 have finally run out of steam. And the attempts at reforms 2.0, whether you talk about liberalization of land, labor, capital, they seem to have stuck for quite a few years, right? It's not as if the government hasn't tried. On land, you had some attempts at, one part of the land, which is the RERA Act. Then there was, for labor, there was this harmonization of labor codes. Something had happened on Rajasthan, starting a few things as well. On capital, we had this IBC, the Insolvency and Bankruptcy Code. So what has happened? Is there further scope for these reforms, or we need to perfect the implementation in some of these areas itself? Where is the ball stuck currently?
Yeah, I may slightly quarrel with it being reforms 2.0. I think it's reforms 3.0. There was a phase in the middle, the NDA 1 in particular, where sort of this shift from, customs duty, FDI, FPI, etc., happened into roads, ports, etc. Right? So from sort of service sector, if you will, reform to, or macroeconomic reform into infrastructure reform happened in Vajpayee. And then all the other reforms that have happened over time, as you speak about. So I would say we are in reforms 3.0. I think as a developing economy goes into multiple stages of reform, it becomes more and more complicated because you're really trying to get at second order effects rather than simple first order effects. But the first order effects we need to improve with implementation. So if we can build a road in 7 days, we should build it in 6, et cetera, right? And, famously, virtually every highway and particularly every bridge that we build takes 10 years longer than it should. And so those things have to change. So I don't think we're paying enough attention to the productivity impact of a lot of these. Now, that said, there's so much more to be done, particularly with respect to jobs. And I think while some of the supply side thing encourages jobs, I do think we will need a fair amount of activity related to jobs in particular. It's not enough to rationalize labor codes, which, again, we have done. It is equally necessary to create further enabling conditions. So roads are a major enabling condition for jobs. And that's something that we worked on quite well for 20 years. Of course, could be better, but it's we worked on very well for 20 years. But there are so many other things, right? I mean, and then we need to go from quantity to quality. So, for instance, 600,000 or whatever, 560,000 villages have been electrified, but the supply is 240 volts is whatever 160 to 280 rather than 240. So the quality of the electricity is poor. Similarly, the Right to Education Act put a lot of children in school. Of course, the pandemic has interrupted that, but a lot of children in school, but the ability for them to read in 5th class at a first grade level hasn't improved that much. So we need to go from a quality revolution to a from a quantity revolution to a quality revolution in the inputs to, all of these things, land, labor, capital, human capital. As we go forward, I'll just finish with the observation that the biggest two things that the East Asia, and most people don't sort of realize it, the biggest two things that fed into the East Asian miracles was one, macroeconomic stability, and two, serious focus on quality of particularly primary education, but also primary health and so on. And we are beginning that second. I think we have taken a fair number of steps towards macroeconomic stability, including the Monetary Policy Committee, for instance. We need to do more of that. But I would say the quality revolution is pending. And it's much more difficult to do than some of the other ones, but that's what we need to work on as we go forward.
Narayan, I want to end with one last question, because finally the economy is driven by private investment, right? And that private investment has been declining over the last few years. So with what the government has started in this budget and over the past few budgets, do you think government investment will be able to crowd in private investment finally, or will we be dependent on governments to do a lot of this spending over the last 4-5 years? How do you see that change happening?
Yeah, so good thing you ended with that, Pranay, because we'll sort of end where we started, which is I think it's good to attempt to try to crowd in. That's better, right? If the government had instead spent, then there would not even have been an attempting at crowd in. So they are attempting to crowd in private investment. I think the jury is still out. Private investment will react to two things. Will react to demand and or potential demand, and will react to inflation. Unfortunately, one of those two factors is negative now, which is inflation. But the second factor is potential demand. So what we have to see is, will some of these supply side incentives actually create demand by putting more money into the hands of the household and more profits in the hands of the corporations than we had a few years ago. So I think the jury is still out. I think it's not going to be a V-shaped private investment recovery, but it's a good attempt rather than try to simply deficit spend your way out of the problem, which is clearly only a cyclical fix. It's not a structural fix to the problem. But I think the government can encourage this by allowing the Reserve Bank to do its job of keeping inflation down. Because if inflation remains high, then even if potential demand is deemed to be high, private investment will be cautious.
Right. Thank you so much, Narayan. So broadly, a good budget on capital investment, etc., but some negatives, especially on not being able to address the downside of the K-shape, and that was one major point. So thank you so much. This was a masterclass on the Indian economy. The good thing about budgets is that it gives us this opportunity to learn the Indian economy better and explore its various intricacies better. So thank you so much, and I hope our listeners will enjoy this episode learning from you. Thank you.
Thank you, Pranay. Always a pleasure.
Thank you for staying on for the full conversation. If you like what we do, please share it with your friends and family. You can also leave us a review or rating on iTunes and Apple Podcasts. The crew that makes these podcasts possible is Gaurav Krishna on sound supervision and production, with support from S. Sarvanaraj and Raghavendra Tenkaila. Artwork and design is by Chandni Venkataraman of Crisscross Design Studio. Don't forget to subscribe to our channel on your favorite podcast platform. It can also be accessed on our website, bangaloreinternationalcentre.org. Do follow us on Instagram for updates on all our programming. This is Lekha Naidu signing off on behalf of everyone at BIC.